Suria Capital provides port services and facilities in Sabah. The group has also widened its business into related sectors. In terms of revenue and profit, the port operations is the largest contributor. The next biggest contributor is the property development segment. Suria Capital initially held the port concession until 2034, but this was extended in 2022 for another 30 years. The extension would improve the bottom line for the company. The group diversified into property development to capitalize the value of its land. This was done via a joint venture where the company basically provided the land and the development risk seemed to be borne by the joint venture partner. This is not a growth company with low revenue and profit after tax growth over the past 12 years. You can see revenue and profit spiked in 2015 due to a one-off sale of the land to its joint venture partner. We can see a similar spike pattern in the returns. The troubling sign is the declining return on equity and return on assets. But I would rate Suria Capital as financially sound with a good capital allocation plan, where its cash flow from operations was sufficient to fund its capex and dividends. A peer comparison showed that this is not a growth sector. The revenue for the market leader Westport grew at 3.3% compounded annual growth rate. Suria Capital also had the worst return on assets over the past few years. The best return was from Westport with an average of around 10%. Suria Capital poor return was because it had the worst gross profit margin. When it comes to valuation, you can see that there is no margin of safety based on the earnings value. But there is more than a 30% margin of safety based on the NTA or book value. The challenge for Suria Capital is the way it has recognized its property development land value. As such, a more appropriate valuation method is to do it via a sum of parts. On such a basis, I estimated it to be worth $2.20 per share. There's also no margin of safety here. Suria's Capital port concession accounted for the bulk of its earnings over the past 12 years. But this is not a high growth sector. The contribution from port development is also small. Given that its return on equity is less than the cost of fund and the lack of margin of safety, this is not an investment opportunity. For details, read the article. Thank you.